When you look at the raw numbers from a company reporting a quarter that is just this flawless, your immediate instinct is to assume the market is going to reward them with, an absolute parade.
Oh, yeah. You expect the stock to just gap up and never look back.
Right. I mean, we are talking about a print that defies the standard gravity of hardware manufacturing. But if you've spent any time tracking semiconductor memory cycles, you know that perfection is terrifying.
It really is.
When a memory supplier posts margins that rival luxury software, the institutional memory of the market just violently kicks in. Investors don't see a permanent plateau of profitability. They see the horrifying precipice of the next cyclical crash.
It's basically the ultimate manifestation of market PTSD.
Yeah.
I mean, you have an investor base that has been conditioned over 30 years to believe that any unprecedented spike in memory pricing is just, the primer for a devastating supply glut.
The higher the gross margin, the faster the inevitable implosion.
Exactly. The market sees these numbers and immediately starts bracing for impact.
Well, welcome to Talk Tickers, your professional earnings call summarization podcast. On today's deep dive, we are staring directly into the center of that paradox. We are looking at Micron Technology's fiscal Q2 2026 print.
And this is a print for the history books.
Truly. And I'm not using hyperbole when I say these results are historically anomalous. They obliterated consensus estimates, they are generating sovereign-level cash flow, and they're guiding for future margins that, frankly, shouldn't be physically possible in a capital-intensive hardware business.
But the stock reaction was just brutal.
Yeah. Leading into the print, the stock slid nearly 4% in regular trading. And the second these pristine numbers crossed the wire, it dropped another 5% after hours.
That disconnect is exactly why this specific earnings call is just a masterclass in narrative collision.
A total collision.
Right, because you have management aggressively asserting that the fundamental physics of their industry have been permanently rewritten by artificial intelligence.
Yep.
They're claiming memory is no longer a volatile commodity, but a critical, scarce infrastructure asset.
Right, they're selling the this time is different story.
They absolutely are. But meanwhile, the market is looking at a massive, multi-billion-dollar capital expenditure plan and basically screaming that the executives are falling into the exact same overbuilding trap they always do.
So you might be wondering how a company can beat revenue estimates by almost $4 billion and still trigger an after-hours sell-off. To understand that, we really have to forensically dismantle these results.
They have to get into the weeds.
We do. We are going to scrutinize the physical limitations of their manufacturing nodes. We're going to tear apart the multi-year lockup contracts they're forcing on their customers. And we'll heavily debate whether the new AI architectures are actually a moat or just an accelerant to the next bust.
We really need to strip away the AI halo effect here, I think. If we look at the raw mechanics of wafer starts, yield curves, and die sizes, we can actually model out whether this time genuinely is different, or if we're just witnessing the mother of all cyclical peaks dressed up in a high-bandwidth tuxedo.
Okay, let's anchor ourselves in the sheer scale of the Q2 snapshot before we tear it apart. The revenue came in at $23.86 billion. That is a 196% year-over-year explosion.
It's a mind-bending number.
It is. Beating the street by roughly 3.8 to $4 billion means their margin of error on the beat is larger than the entire market cap of some of the companies buying their chips.
Which is just an insane perspective to have.
Right. And non-GAAP earnings per share hit $12.20, absolutely crushing the 9.28 consensus. Operating cash flow was $11.9 billion, adjusted free cash flow of $6.9 billion, plus a 30% dividend increase.
See, the operating cash flow is the metric that should really force a double take.
How so?
Well, when you're converting roughly half of your top-line revenue directly into operating cash flow in a business that requires pouring billions into raw silicon and extreme ultraviolet lithography machines.
Which are not cheap.
Not at all. When you do that, you are exhibiting a level of pricing leverage that usually triggers antitrust investigations in other industries. It's just off the charts.
I want to focus on the sequential jump, though, because that is where the math starts to look, honestly, unsustainable to me. The revenue increased by $10.2 billion just from Q1 to Q2.
$10 billion in 90 days.
They added $10 billion of new revenue in a single quarter, the largest single quarter jump in the company's history. And if you look at the pricing power driving that across the segment mix, it's brutal.
It really is.
DRAM is 79% of their total revenue, And the average selling prices, the ASPs, were up in the mid 60% range sequentially, not year over year, quarter over quarter.
And NAND, which makes up the remaining 21%, saw ASPs up in the high 70% range sequentially.
That's just wild.
It's the financial manifestation of sheer panic from the hyperscalers. I mean, they are not negotiating on price anymore. They are purely negotiating on allocation. Just give me the chips. I don't care what they cost.
But here is where my skepticism really peaks. When you raise prices by 70% in 3 months on a relatively fixed cost manufacturing base, your margins violently expand. Non-GAAP gross margin leapt 18 points sequentially to 74.9%. And then, this is the jaw dropper for me, they dropped the Q3 guidance.
Oh, the Q3 guide was something else.
$33.5 billion in revenue, roughly 19.15 in EPS, and a gross margin hitting approximately 81%. 81%. And just to put that revenue guide in perspective, that single quarter revenue guide exceeds the full year revenue of any year in the company's history prior to fiscal 2024.
81% gross margin on a physically manufactured good. It's basically unheard of.
It is absurd. I mean, it's like selling shovels in a gold rush, but where the shovel maker suddenly realizes they are the only one on earth with steel. Basic economics dictates that an 81% gross margin on a physical component is a structural anomaly that capitalism will violently correct.
That's the textbook response, yeah.
Yeah, right. Either competitors flood the market with supply to capture those margins, or the end customers simply balk at the pricing and you destroy your own demand. The miners stop buying the shovels if the shovel costs more than the gold they're digging up. So at 81% gross margin, are we hitting a ceiling? How is management justifying a defense of that margin level?
You're hitting on the fundamental friction point of the entire call here. Let's tackle the demand destruction argument first. Management's thesis is that the elasticity of demand for memory in the AI data center is currently, well, non-existent.
Non-existent.
Right. Think about the capital structure of training a frontier AI model right now. A hyperscaler like Microsoft or Meta is sinking billions into the compute clusters. The GPUs, the networking fabric, the power infrastructure.
Actually, billions of...
Billions. And the memory is the critical bottleneck for the entire system's performance. So if you bottleneck a $5 billion GPU cluster because you wanted to save a few $100 million on DRAM, you are fundamentally misallocating capital.
Penny wise, pound foolish.
Exactly. The cost of delaying a frontier model's training run by 3 months because you didn't secure memory allocation is vastly higher than paying a 70% premium on the silicon itself.
Okay, I understand the FOMO driving the hyperscalers. The fear of losing the AI arms race overrides any standard procurement budget. But there is a mathematical limit to margin expansion. I mean, even if they hike prices another 50% next quarter, they can't maintain that trajectory of margin growth forever.
Mechanically, that is absolutely true, and they are approaching a mathematical asymptote.
Right.
When you are already at an 81% gross margin, the denominator is so large that incremental price hikes have a diminishing effect on the percentage.
Give me an example of how that works.
Sure. So if a chip costs $20 to yield and you sell it for $100, that's an 80% margin.
Okay.
If you squeeze the customer and charge $150, your absolute profit explodes. But your margin percentage only creeps up to 86%.
Got it.
So yes, the rate of margin expansion is hitting a ceiling. But the absolute cash flow generation at that plateau is just staggering. It's a multi-year AI investment cycle meeting severe structural supply constraints.
That brings us to the supply side of the capitalist correction, though. If I am a competitor and I see Micron pulling 81% margins, I am doing everything in my power to spin up idle capacity, flood the zone, and steal market share. Management is arguing that the physical constraints of the AI memory architecture prevent this.
And this is where we have to transition away from standard commodity economics and look at the physical architecture of what they're actually selling.
Okay, let's get into it.
Management is vehemently arguing that this AI supercycle has fundamentally recast memory from a volatile, interchangeable commodity into a bespoke strategic asset. And they introduced this concept of the Strategic Customer Agreement, the SCA.
Right, SCAs.
Which I honestly believe is the most crucial financial lever discussed on this entire call.
Historically, memory was treated like wheat or crude oil, right? I mean, Dell or HP didn't care whose logo was stamped on the DRAM modules going into their laptops. They bought whatever was cheapest on the spot market.
Exactly. It was a race to the bottom on price.
If there was a supply glut, they bought it for pennies. If it was tight, they signed short-term, 12-month, long-term agreements, LTAs, which offered minimal visibility. But on this call, they announced their first ever 5-year SCA with a major customer.
A 5-year binding lockup on silicon capacity. In the semiconductor memory space, that is virtually unprecedented.
It's a massive paradigm shift.
Completely. It totally alters the risk profile of the balance sheet. Customers are so desperate for supply visibility that they are locking in multi-year commitments. It shifts the company's financial profile from this boom and bust cyclicality toward stable, predictable infrastructure-like revenue.
I have to acknowledge the durability of this, though. A 5-year contract in the tech sector feels like an absolute eternity.
It is a lifetime in tech.
Right. If I'm a massive hyperscaler and I lock in 5 years of memory supply at near peak pricing, what happens when the AI hype cools off? What happens when I realize my data centers are overbuilt, the enterprise SaaS integration of my AI tools isn't generating the revenue I modeled, and suddenly I just don't need all these chips in 2028? Doesn't the memory supplier just get left holding a massive, unenforceable contract? We've seen companies break supply contracts before when the macro environment shifts.
You are echoing the exact skepticism the analysts threw at management during the Q&A.
Well, it's the logical question to ask.
Oh, totally. But the executives countered by emphasizing that these SCAs contain highly, quote, robust terms designed specifically to insulate their gross margins regardless of the broader macro environment.
Robust terms, what does that actually mean?
Well, they obviously hid behind confidentiality clauses and didn't detail the exact legal mechanics. But in this specific tier of semiconductor procurement, robust terms usually means draconian take-or-pay structures.
Meaning the hyperscaler either takes physical delivery of the memory or they pay a catastrophic financial penalty that makes breaking the contract mathematically irrational.
Precisely. It also almost certainly involves rigorous floor pricing.
Ah. Yeah.
So even if the broader spot market for legacy DRAM collapses, the price for the specific customized AI memory covered under the SCA is contractually forbidden from dropping below a baseline that guarantees the supplier their target return on invested capital.
That's a huge safety net.
It is. And furthermore, these agreements often involve massive upfront cash prepayments from the customer just to fund the bespoke cleanroom expansions required to build the chips in the first place.
So they are essentially forcing the hyperscalers to act as their venture capital and internal insurance policy simultaneously. They're transferring the cyclical risk from their own balance sheet directly onto the balance sheets of their largest customers.
That is the strategic masterstroke. If they can execute on this, and they stated they are deep in negotiations to sign several more of these 5-year SCAs, it permanently re-rates the valuation multiple of the stock.
Because it's a different business model at that point.
Exactly. You can no longer value them as a boom and bust commodity cyclical. If 40 or 50% of their advanced node capacity is locked into utility-style, high-margin, non-cancelable infrastructure contracts.
But the only reason a hyperscaler agrees to those borderline extortionate terms is out of sheer existential terror that they won't get the specific hardware they need. We really need to look at the actual technology driving this desperation.
The underlying silicon.
Yes, it all centers on the data center, which management noted is on track to consume over 50% of the industry's entire bit TAM total addressable market for the first time ever in calendar 2026.
That is a staggering pivot when you think about it. For decades, the memory market was dictated by consumer devices. First, it was the PC upgrade cycle. Then it was the smartphone supercycle.
And now the edge is taking a backseat.
All right, now the center of gravity has violently shifted to the enterprise data center. And the apex predator of that data center is high bandwidth memory, HBM.
Management dropped some massive product roadmap updates here during the call. They highlighted that they have already initiated volume shipments of their HBM4 36GB 12-high product in Q1 of 2026. And they explicitly stated it is designed to pair with NVIDIA's Vera Rubin architecture.
To understand why customers are signing 5-year SCAs, you have to understand the brutal physical complexity of that specific HBM4 package.
Break it down for us.
Sure. We are not talking about standard flat memory chips soldered onto a green motherboard anymore. AI processors, like those Vera Rubin GPUs, are crunching parameters so rapidly that traditional memory traces create a catastrophic data traffic jam. The GPU literally starves for data.
So they stack the memory vertically instead.
Right, but stacking 12 active silicon dies is a material science nightmare. You thin the silicon wafers down to fractions of a millimeter, then you drill thousands of microscopic holes directly through the active silicon.
Through silicon vias.
Yes, TSVs. You fill those holes with copper to create vertical data highways. Then you stack the 12 dies on top of each other using microbumps, perfectly aligning tens of thousands of connections.
And if a single one of those microscopic copper pillars is misaligned by a fraction of a micron, or if a single die in that 12 high stack has a defect, what happens?
The entire package is dead. You throw the whole thing in the trash.
Yeah.
The yield loss is brutal. Furthermore, you have 12 layers of silicon generating heat in a microscopic footprint sitting right next to a GPU that is running at hundreds of watts.
The heat must be insane.
It is. The thermal dissipation challenges alone dictate that only a few companies on Earth can reliably manufacture this at volume.
Which makes their claim about yields so critical. They stated they expect to reach mature yields on this HBM4 generation faster than they did on the previous HBM3E generation. If they are actually accelerating their yield learning curve on a more complex 12-high architecture, that is a massive operational flex.
A huge flex.
It means less silicon in the trash, drastically lower cost per gigabyte, and more supply to actually feed the hyperscalers.
And they're relentless on the roadmap, too. They're already sampling an HBM4 16-high product, which bumps capacity to 48 gigabytes per stack.
That's a 33% increase over the 12-high.
Exactly. And they have HBM4E development already underway for a 2027 ramp. They are sprinting because the parameter counts of the frontier LLMs are scaling exponentially, demanding exponentially larger and faster memory pools just to run inference.
I have to throw a wrench into this HBM supremacy narrative, though, because during the Q&A, analysts really grilled management on the threat of alternative AI compute architectures, specifically the rise of language processing units, LPUs, and architectures that heavily utilize SRAM.
Ah, the Grok threat.
Exactly, the Grok threat. You have companies pioneering architectures that use static random access memory SRAM built directly onto the logic chip itself. It is blisteringly fast, it eliminates the data travel time entirely, and for certain specific inference tasks, it completely negates the need for external HBM.
It's a very real architectural shift.
So if I am holding this stock at peak multiples, I am terrified that an architectural shift to SRAM-heavy LPUs bypasses my 81% margin HBM golden goose entirely. Doesn't that threaten their entire moat?
It is definitely the most credible architectural threat to the HBM thesis. But management's rebuttal was highly technical and, I thought, very persuasive. They offered a two-pronged defense.
Let's hear the first prong.
First, on the macro level, any innovation that dramatically lowers the cost of inference or power consumption per generated token, like an LPU, is actually a net positive for the total addressable AI market.
Because it makes AI cheaper to run.
Right. It democratizes AI access, sparks broader enterprise deployment, and vastly expands the total number of AI servers deployed globally.
Okay, so a rising tide lifts all compute platforms.
Yep.
But that doesn't answer the specific threat of HBM obsolescence.
Which brings us to their second, technical defense. Even if the processor itself relies heavily on internal SRAM for immediate token generation, you cannot fit a trillion parameter multimodal model into on-chip SRAM.
It's just too big.
It is physically impossible. SRAM is way too large physically and far too expensive per bit. Therefore, these advanced LPU setups still exist within a massive rack-scale architecture.
Right. They specifically name-dropped architectures like NVIDIA's GB200 NVL72 rack configurations to make this point.
Exactly. When you are operating at the rack scale, integrating dozens of compute nodes to act as a single massive GPU, the system requires a titanic external pool of memory to hold the model weights, the KV cache, and the context window.
And how big is that pool?
Management pointed out that a single advanced rack configuration can require up to 12 terabytes of advanced DDR5 memory.
12 terabytes of RAM just to feed a single rack.
The overarching logic is inescapable. You cannot scale AI context windows, which are moving from thousands of tokens to millions of tokens, without massively expanding the external memory tiers.
So whether the immediate bottleneck is solved by HBM sitting right next to the GPU, or by terabytes of LPCM M2 memory pooled at the rack level, the structural demand for the underlying silicon remains. The architecture might shift the mix, but it doesn't shrink the TAM.
Let's talk about that underlying silicon, because surviving an AI supercycle isn't just about stacking HBM higher. It's about the foundational atomic blueprint of the wafers you are printing.
The manufacturing nodes.
Yes. If you are promising hyperscalers a 5-year lockup on capacity, your manufacturing node better be absolutely flawless. We need to look at their transition to the 1 gamma DRAM and G9 NAND nodes.
This is where operational execution separates the leaders from the laggards. Transitioning a massive fabrication facility to a new microscopic node is fraught with peril. If your lithography tools are miscalibrated, your yields plummet and you bleed billions in operating losses.
But management noted that both 1-gamma DRAM and G9 NAND are aggressively ramping and are on track to become the majority of the company's bit mix by mid-2026. Over half of their global production will be on their absolute bleeding-edge lines, which is a huge achievement if they pull it off.
And the key technological driver behind the 1-gamma success and the upcoming 1-delta node is their planned increase in extreme ultraviolet or EUV lithography adoption.
Which is a massive pivot for them. For years, there was a fierce debate in the industry about when to fully embrace EUV for memory manufacturing.
I look at their historical reluctance and I have to ask, why hold out on EUV for so long? I mean, the logic makers like TSMC and Intel adopted EUV years ago. Why did the memory suppliers try to squeeze every last drop out of the older deep ultraviolet or DUV machines?
It comes down to cost and throughput, ultimately. An EUV machine from ASML costs hundreds of millions of dollars, consumes an obscene amount of electricity, and initially had lower throughput, meaning it processed fewer wafers per hour than mature DUV tools.
So it's just a margin calculation.
Yeah. Exactly. Memory is historically a low-margin commodity, so suppliers used a technique called multi-patterning with DUV. Instead of buying a new $200 million EUV tool to draw a tiny feature, they used cheaper DUV light, but they used multiple stencils and passed the wafer through the machine 3 or 4 times to create the necessary density.
But physics eventually calls your bluff, right?
Precisely. As they pushed into the 1-gamma and 1-delta nodes, the features became so unimaginably small that multi-patterning with DUV became a total nightmare. You were exposing the wafer, etching, depositing, and re-exposing it so many times that the probability of a defect compounds with every single step.
Yields just crash.
Yields crash. Furthermore, multi-patterning requires massive cleanroom space because you need a small army of DUV machines to do the work of a single EUV tool.
So the transition to EUV isn't just about printing finer lines, it's about optimizing the physical footprint of the fab. EUV uses light with a wavelength of 13.5 nanometers. You replace a highly complex multi-step DUV process with a single, elegant EUV exposure.
Right. It drastically simplifies the manufacturing flow.
It improves the yield curve and frees up precious cleanroom real estate for more wafer starts. That's huge.
And the output of that 1-gamma EUV node is what actually enables the rack-scale solutions we were just discussing. Management highlighted the industry's first 256 gigabyte LPVM2 product.
Built on 1-gamma, right. They claimed this enables a staggering 2 terabytes of capacity per CPU, which effectively quadruples the memory content in these servers from just a year prior.
This is the critical linkage between the manufacturing node and the AI architecture. LPCMM2 is a completely new form factor. It takes low-power memory and packages it in a way that allows it to sit incredibly close to the CPU while drastically reducing power consumption compared to traditional server DIMMs.
So it's faster and more efficient.
Exactly. When you can pack 2 terabytes of memory right next to the processor, you eliminate the latency of having to fetch data from slower storage tiers. The CPU isn't sitting idle waiting for parameters. It is constantly fed.
But the storage tiers are evolving just as violently. Let's shift from the DRAM side of the house over to the NAND side. The data center SSD revenue, the permanent storage flash memory, more than doubled sequentially.
100% revenue increase in 90 days.
Right. Enterprises don't just arbitrarily decide to double their flash storage budget overnight. What specific AI workload is forcing that kind of panicked buying?
It is entirely driven by the underlying mechanics of how large language models actually retrieve and process information. Management pointed to 2 specific drivers: vector databases and KV cache offloading.
Let's pull those apart because that's fascinating. If I am an enterprise running a massive internal LLM, why do I need a vector database and why does it require bleeding edge SSDs instead of cheap spinning hard drives?
Well, a traditional relational database like a standard SQL setup stores data in rigid tables, rows and columns. It's great for pulling up a customer's billing address. But an LLM doesn't understand the world in rows and columns. It understands the world through semantic relationships. It takes concepts, words, and images and translates them into high-dimensional mathematical coordinates called vectors.
It's mapping relationships, essentially.
Right. So if you want your AI to search through 1 million internal legal contracts to find a clause that feels similar to a specific liability risk, it isn't looking for a keyword match. It is calculating the mathematical distance between millions of vectors in multidimensional space.
And doing that math across millions of coordinates requires massive, instantaneous random read performance.
Exactly. A spinning hard disk drive relies on a physical read-write head moving across a magnetic platter. The physical latency of that mechanical movement is an absolute eternity to an AI processor.
It's just too slow.
Way too slow. If your vector database is housed on hard drives, your multi-million-dollar GPU cluster sits completely idle, burning power, waiting for a mechanical arm to find a file. High-capacity, high-speed NVMe SSDs are the only storage medium capable of keeping the vector database fed at the speed of inference.
Which brings us to the second driver, KV cache offloading. What exactly is a KV cache?
KV stands for key value. When an LLM is in the middle of a generation task, say, summarizing a 500-page document, it has to remember the context of everything it has already read and everything it has already generated. It stores this context in the KV cache.
And as the context windows get larger, we're talking moving from 8,000 tokens to millions of tokens now. That cache just explodes in size.
Right, and you want to keep that cache in the fastest memory possible, which is the HBM on the GPU. But as we discussed, HBM is incredibly scarce and expensive. You can't fit a massive KV cache in there.
So what do?
The system architecture has evolved to tier the memory. It offloads the older, less immediately relevant parts of the KV cache onto fast SSDs.
To capitalize on this, management highlighted a new 122 terabyte high-capacity SSD. To fully grasp the engineering here, this single drive delivers 16 times the sequential read throughput per watt compared to a standard hard disk drive.
That per watt metric is the secret to the entire data center segment right now.
Because of the power crunch.
Absolutely. Power is the absolute limiting factor for AI expansion. Hyperscalers simply cannot pull enough electricity from the grid to power these clusters. If you can swap out banks of power-hungry, slow hard drives for a few 122 terabyte SSDs that deliver 16 times the performance for the same energy footprint, it frees up critical power overhead that you can immediately allocate back to your GPUs.
It is an architectural necessity disguised as a storage upgrade.
Exactly.
So the data center thesis is airtight. The physics, the power constraints, and the architectures all point to massive structural demand. But no memory supplier survives on the data center alone. We have to address the rest of the market.
Let's look at the edge AI ripple effect. We were talking about personal computers, smartphones, autos, and robotics.
The edge is where the macroeconomic reality kind of collides with the AI narrative.
And it creates a very tricky divergence that we really need to scrutinize. Management openly admitted that end market unit volumes for PCs and smartphones are expected to decline in the low double digits in calendar 2026, which is concerning. On the surface, if you were a component supplier and your customers are projecting a 10 to 15% drop in the number of physical devices they plan to manufacture, that is a catastrophic warning sign.
Exactly. Why are the units dropping? Is the consumer just globally tapped out?
It's a combination of consumer fatigue and the exact pricing dynamics we've been discussing. Because memory supply is so structurally tight, the cost of the memory components going into a standard laptop or smartphone has skyrocketed.
And the OEMs have to pass that on.
Right. The device manufacturers, the OEMs like Apple, Dell, Samsung, have to pass those costs onto the consumer. When the base price of a laptop jumps by $300, the elasticity of consumer demand snaps. People hold on to their 3-year-old laptops and crack screen phones for an extra cycle.
So if device volumes are crashing, how is management modeling continued revenue growth in these segments?
They're relying entirely on a phenomenon called content growth.
Content growth.
Yes. They are betting that the sheer volume of memory required per device will vastly outpace the decline in the number of devices sold. It is the ultimate volume versus value paradox.
Let's run the numbers on that bet because they are banking hard on the AI PC narrative.
Okay.
They pointed out that a true AI PC, a machine capable of running local agentic AI tasks, background LLMs, and real-time inference without pinging the cloud, requires a minimum baseline of 32 gigabytes of DRAM.
Which is double the historical baseline. For years, the standard enterprise laptop shipped with 16 gigabytes.
Right.
So even if Dell sells 10% fewer laptops overall, if every laptop they do sell contains 100% more memory, the net demand for memory bits still grows massively.
And at the high end, it's even more aggressive. Personal AI workstations designed for developers and data scientists are shipping with 128 gigabytes of RAM.
Because if you want to run an 8 billion parameter model locally to test code without paying cloud inference fees, you need that massive pool of unified memory.
The dynamic is identical in the smartphone market. Management noted that nearly 80% of flagship smartphones are now shipping with 12 gigabytes or more of DRAM. Just 12 months ago, that number was under 20%.
It's a massive jump.
The mobile OEMs are desperately trying to enable on-device AI features to drive upgrade cycles, and they are forced to pack the phones with memory to do it. Value is completely overriding volume.
And that content growth story extends far beyond traditional consumer screens. We have to look at the automotive and industrial segment, which just posted a record quarter of over $2 billion in revenue.
That is a Fortune 500-sized business hiding inside their broader corporate structure. And it is being driven by a structural tailwind that frankly rivals the data center, the transition to autonomous driving.
The memory requirements for advanced driver assistance systems are scaling vertically.
They provided a brilliant benchmark for this on the call. Today, a standard vehicle equipped with Level 2 ADAS, which is basically advanced adaptive cruise control, lane centering, and emergency braking, contains roughly 16 gigabytes of DRAM.
It's essentially a mid-range laptop running the car.
Exactly. But as the industry pushes toward Level 4 autonomy vehicles that can fully navigate and drive themselves under specific conditions without any human intervention, the compute architecture fundamentally changes. Management stated that an L4 vehicle will require over 300 gigabytes of DRAM.
300 gigabytes. The vehicle ceases to be a car and becomes a mobile, ruggedized data center.
Think about the physics of what that system is doing. It is ingesting high-definition video feeds from a dozen cameras, layering real-time LiDAR point clouds, processing ultrasonic radar, and running local AI inference to predict the trajectory of a pedestrian stepping off a curb in milliseconds.
You cannot send that data to the cloud and wait for a response.
The latency would be lethal. It has to be processed entirely on the edge.
And this is highly specialized, incredibly sticky revenue. They are supplying this market with industry-first, automotive-grade 1-gamma LPDDR5 and G9 UFS 4.1 storage solutions.
Automotive grade is a key distinction there.
It is. It means the silicon has been engineered and certified to survive wild temperature swings, from freezing winters to baking desert heat, while enduring constant physical vibration for a decade without a single bit flip error.
That's a tough environment for silicon.
Very tough. The qualification process for an automotive OEM takes years. Once you are designed into the vehicle's platform, the OEM will never swap you out for a cheaper competitor because the requalification cost is simply too high.
And then, almost as an aside, management threw out a wildly ambitious 20-year thesis. They explicitly claimed that humanoid robotics will be the next massive multi-decade growth vector for the memory industry.
They project that a functioning humanoid robot will require a compute platform that rivals or exceeds the architecture of a high-end Level 4 autonomous vehicle.
Which makes intuitive sense. If an autonomous car needs 300 gigabytes of RAM to navigate a relatively structured environment like a highway, a bipedal robot that has to dynamically balance itself, navigate unstructured human environments, process natural language commands, and perform fine motor tasks with its hands is going to require astronomical real-time compute capabilities.
It is the ultimate manifestation of the edge AI thesis. By planting a flag in robotics, management is signaling to long-term investors that the demand curve for high-performance memory is fundamentally decoupling from the legacy PC and smartphone upgrade cycles. They are underwriting a future where intelligence is embedded in every physical system.
Okay, we have painted an immaculate, hyper-bullish picture. Unprecedented 81% margins, 5-year lockup agreements, EUV transitions, AI supercharging the data center, and a future filled with autonomous cars and robots.
Which means it is time to face the bear case.
Absolutely, because despite this incredibly cohesive, fundamentally sound narrative, the stock dumped 5% after the call. The market heard all of this and still smashed the sell button. We have to confront the elephant in the room. Capital expenditures, capacity expansion, and cyclical terror.
The sell-off is entirely anchored to the price tag of maintaining this leadership. The sheer scale of the capital expenditure numbers terrify the analysts.
Let's lay out the absolute numbers. Management announced they are raising their fiscal 2026 capex to over $25 billion. That is a massive number on its own.
It's a huge number.
But the detail that truly spooked Wall Street is the guidance for fiscal 2027. They stated that FY27 capex will step up meaningfully and specifically highlighted that construction-related spending alone is going to jump by more than $10 billion year over year.
Yeah, when a hardware manufacturer tells Wall Street they are going to spend an extra $10 billion just on pouring concrete and erecting structural steel, every klaxon in the financial district goes off.
I have to play the skeptic here because history is not on management's side. In the memory industry, massive multi-geography capacity expansion has historically been the exact mechanism that triggers the next devastating crash.
A classic boom-bust cycle.
Right. Executives look at high spot prices, assume the good times will last forever, and greenlight massive fabs. By the time the fab actually comes online 3 years later, the macro environment has cooled, demand has softened, and suddenly you have a multi-billion-dollar facility churning out supply into a glutted market.
And prices collapse.
Prices collapse, inventory gets written down, and those 81% gross margins evaporate into 10% margins overnight. Why is a $10 billion spike in construction not absolute proof of management hubris?
To evaluate that, we have to look at exactly where this money is going. The geographic footprint of this expansion is essentially a global logistical empire-building exercise. They're simultaneously breaking ground across 3 different continents.
Let's audit the map. They are starting in Taiwan, which is the traditional heartland of their advanced manufacturing. They just closed the acquisition of the PSMC Tungalo P5 site. They expect meaningful product shipments from that existing fab to begin in fiscal 2028. Furthermore, they are planning to begin construction of a second, entirely new clean room at that same site by the end of fiscal 2026.
Expanding in Taiwan makes operational sense. The talent and supply chains are deeply entrenched there, but they are aggressively diversifying their geopolitical risk.
Look at the U.S. footprint. They are projecting initial wafer output from their first Idaho fab in mid-calendar 2027. They have already begun ground preparation for a second massive fab in Idaho. Meanwhile, on the East Coast, they've officially broken ground on their first mega fab in New York.
And the expansion in the rest of Asia is just as aggressive.
It is. They are bringing a dedicated advanced packaging facility online in Singapore in 2027, explicitly to handle the complex HBM stacking we discussed earlier. They are also breaking ground on a completely new NAND fab in Singapore, targeting initial output in the second half of 2028. They have a new state-of-the-art assembly and testing facility in India that has already commenced commercial shipments, and they are expanding their advanced clean rooms in Hiroshima, Japan.
It is an unprecedented blitz of capital allocation.
But consider the mechanics of this expansion. By building out Idaho, New York, Taiwan, Singapore, India, and Japan all at once, aren't they virtually guaranteeing that by the time we hit 2028, the market will be drowning in advanced node memory?
This is the exact debate raging across institutional trading desks right now. But management deployed a highly sophisticated 3-part defense to argue that this time, the supply dynamics are structurally insulated from a glut.
A 3-part defense.
Yes, they are drawing a hard line between traditional cyclical oversupply and the current reality of structural supply constraints.
So defend the $25 billion capex bill using their logic. Why won't this cause a crash?
The first pillar of their defense is the sheer physical complexity of building greenfield fabs. A greenfield project means you aren't just slotting new lithography machines into an empty room in an existing building. You are buying an empty field, surveying the land, and building a multi-billion-dollar facility from absolute scratch.
The logistics of which are staggering.
Exactly. You have to secure environmental permits, you have to negotiate with local utilities to secure hundreds of megawatts of dedicated power. You need millions of gallons of ultra-pure water.
Just the infrastructure alone is a nightmare.
It is. You have to pour a monolithic concrete foundation so thick and perfectly isolated that the vibrations from a passing truck a mile away won't misalign an EUV laser operating at the nanometer scale. Then you have to build Class 1 clean rooms the size of multiple football fields.
So it's not a quick process.
Not at all. Management is arguing that the sheer bureaucratic and physical friction of greenfield expansion means this new supply will bleed into the market incredibly slowly. You cannot rush the pouring of that concrete, no matter how much money you throw at it.
Okay, the supply comes online slowly. What is the second pillar of the defense?
The second argument is the reality of declining bit growth per wafer. Historically, Moore's law bailed out the memory industry. Every time you transition to a new manufacturing node, you shrank the transistor so much that you got a massive, virtually free boost in the total gigabytes produced per wafer.
You yielded more product without needing more factory space.
Right. But as we push into the 1 gamma and 1 delta regimes, we are running into the hard limits of atomic physics. The shrink is becoming exponentially more difficult and expensive to achieve.
The gains are shrinking.
Because the physical density gains are slowing down, The natural baseline bit growth of the entire industry is structurally decelerating. You have to build more physical fabs just to maintain historical growth rates because the wafers themselves aren't giving you the free capacity boost anymore.
That makes the $10 billion construction bill look more like a maintenance cost than an aggressive expansion. But what about the third argument?
The third argument is the most critical dynamic in the entire semiconductor ecosystem right now. It is called the HBM trade ratio.
We touched on HBM earlier, but how does it act as a defense against oversupply?
It comes down to the physical footprint of the chip. To manufacture 1 gigabyte of high bandwidth memory, it consumes vastly more raw wafer capacity, clean room time, and testing resources than producing 1 gigabyte of standard DDR5 memory. The physical die size of the HBM logic base and the memory layers is massive.
Right.
Furthermore, the complex packaging, the TSV drilling, the micro bumping, the 12-high stacking results in significantly lower overall throughput and yield.
So the math is fundamentally cannibalistic.
Precisely. Because the hyperscalers are demanding so much HBM for their AI clusters, the memory suppliers are forced to dedicate a disproportionate amount of their wafer starts to HBM production. But because HBM is so wildly inefficient to produce from a raw capacity standpoint, the factories are actually churning out fewer total bits of memory overall.
Wow, so the HBM is eating the rest of the supply.
The HBM production lines are physically hogging the capacity that would otherwise be used to flood the market with cheap standard DRAM.
The HBM trade ratio acts as an artificial physical brake on overall memory supply growth. That is fascinating. It means the very product driving their 81% margins is also the mechanism preventing them from oversupplying the broader market.
Management really hammered this reality home during the call. They stated plainly that despite all these multi-billion-dollar investments in fab expansions, their key enterprise customers are currently only receiving 50 to 66% of the memory allocation they are desperately requesting for the medium term.
They can't make them fast enough.
The industry is fundamentally structurally starved for bits.
So, synthesizing all of this into the broader investor context, we are looking at a profound, almost ideological divide on Wall Street right now.
It is a pure battle of narratives.
It is. On one side of the chasm, you have management outlining a thesis of structural, enduring scarcity. They are pointing to the unprecedented 5-year strategic customer agreements locking up capacity. They are highlighting platform-level architectural shifts with HBM4 and LPPAMM2. And they are detailing how the greenfield logistics, physics of the nodes, and the HBM trade ratio make it physically impossible to oversupply the market.
In their view, a $25 billion capex bill isn't reckless expansion. It is the absolute bare minimum required to fulfill the binding take-or-pay contracts they've already signed.
But on the other side of the chasm, the market is chained to its historical trauma. Analysts see a $25 billion capex print. They zero in on a $10 billion explosion in construction costs. They see an 81% gross margin, and their institutional muscle memory violently rejects the "this time is different" narrative. They price in the cyclical peak immediately.
It's a massive standoff.
If you are an investor trying to navigate this divide, what specific metrics do you need to ruthlessly track over the next 12 to 24 months to determine which narrative is actually playing out in reality?
You need to isolate few specific indicators. First, track the execution on the margin guide. Can the company actually hit the high end of that 81% gross margin target next quarter without triggering demand destruction in the PC and smartphone segments?
Right, if prices go too high.
If unit volumes collapse faster than content grows, the margin thesis fractures. Second, ruthlessly monitor the SCAs. Do they announce additional 5-year strategic customer agreements on the next call? If management can successfully lock up 40 or 50% of their total advanced node capacity in multi-year, non-cancelable contracts, the cyclical bear case effectively disintegrates.
And the third indicator?
Cash flow stability. The ultimate proof that AI has rewritten the rules of the memory market is a smoothing of the earnings volatility over a multi-quarter, multi-year period. If they can demonstrate that their operating cash flow is no longer subject to the violent, unpredictable swings of commodity spot pricing, the broader market will be forced to capitulate and re-rate the stock with a higher infrastructure-like valuation multiple.
That structural tension provides the perfect runway for our signature closing segment. Welcome to the This Is Not Financial Advice segment of the Deep Dive. This is where we step away from the pure analysis, put on our hypothetical hedge fund hats, and pitch an outrageous but mechanically plausible trade idea based strictly on the hidden dynamics we uncovered in today's source material.
I have been refining a thesis based entirely on the edge AI dynamics we discussed earlier. I call it the hardware squeeze pairs trade.
I love a good pairs trade. Walk us through the mechanics.
We are going to construct a portfolio that goes long on the suppliers and short on the assemblers. The long leg of the trade involves buying long-dated, out-of-the-money call options, ELIPs, on the advanced memory suppliers. We are taking a leveraged bet that management's narrative is entirely accurate. The 5-year SEAs are ironclad, the HBM trade ratio keeps wafer capacity brutally tight, and those 81% gross margins stabilize at historic highs rather than collapsing.
Okay, we are betting heavily on the structural scarcity narrative. What is the short leg of the pair?
We pair that massive long position by aggressively shorting a curated basket of consumer PC and smartphone original equipment manufacturers, the OEMs, the companies that actually build and sell the physical laptops and phones.
Shorting the device makers at the exact moment they are pitching the AI PC supercycle to consumers, that is incredibly contrarian. What is the underlying rationale?
It all comes back to the lethal vice of the volume versus value divergence. The memory suppliers are currently operating like an apex predator. Because supply is so constrained, they are enforcing brutal high-margin, multi-year contracts on the PC and phone makers. The OEMs must buy this memory. They cannot build the AI PCs and AI smartphones they promised Wall Street without doubling the DRAM from 16 gigs to 32 gigs.
They're captive buyers in a seller's market.
Exactly. But look at their end consumer. Because the OEMs are forced to pay exorbitant prices for the memory, the final retail cost of the device skyrockets. And we already saw the data. End consumer unit sales are projected to drop in the double digits because the average consumer is balking at the price tag.
So the device manufacturers are trapped in a margin-crushing paradox. Their fundamental input costs, specifically advanced memory, are skyrocketing and locked in via multi-year contracts. But their end market demand is shrinking due to price sensitivity.
If the OEMs try to pass 100% of that memory cost onto the consumer, their sales volume collapses even further, destroying their top line. If they decide to eat the cost internally to keep the retail price artificially low and maintain sales volume, their operating margins get absolutely obliterated.
The memory suppliers extract all of the profit out of the hardware ecosystem, leaving the OEMs starving.
That is the thesis. The component suppliers capture all the margin expansion, while the device assemblers absorb all the volume decline pain. Long the apex predators, short the captive assemblers, the hardware squeeze.
That is a devious, highly logical play on the supply chain dynamics. But as always, we must issue a firm and unequivocal reminder. The trade ideas discussed in this segment are strictly for educational and entertainment purposes. We are analyzing mechanics, not offering tailored investment recommendations. Please do your own due diligence.
Absolutely. This is a theoretical exercise, not financial advice.
To bring it all back together, the terrain we covered today is monumental. We dissected a quarter of historic, gravity-defying revenue growth and 81% margin projections. We unpacked the profound strategic shift toward 5-year lockup agreements, signaling a level of desperation for AI infrastructure that the industry has never seen. And we stared down the multi-billion-dollar capex debate, analyzing the physical greenfield constraints and HBM trade ratios that might actually prevent the next great memory crash.
It is arguably the most fascinating case study in the market right now. You are watching real-time technological shifts violently collide with decades of entrenched market psychology.
And that collision leaves us with a final, provocative thought experiment for you to chew on. Throughout this deep dive, we debated whether memory is evolving from a cyclical commodity into a stable infrastructure asset. But take that logic to its absolute extreme. If these 5-year take-or-pay strategic customer agreements become the industry standard, if memory suppliers guarantee their cash flows and put a hard floor under their margins, they cease to trade like highly volatile tech stocks. They begin to look mathematically like regulated utility companies.
Well, they're selling silicon electricity.
Exactly. And if a massive chunk of the semiconductor sector transitions from high beta cyclicality to stable utility-like predictability, does the entire global technology index need to be fundamentally reweighted? If the foundational layer of AI compute trades like a power company, the ripple effects on index funds, beta calculations, and global portfolio allocations could be historic. The financial plumbing of the market might have to be entirely rewired just to account for the stability. Think about that. Thank you for joining us on this exploration. We are Talk Tickers, and we are committed to tearing apart the narratives, analyzing the physics, and bringing clarity to the earnings chaos. We will be watching the tape next quarter to see if those margins hold or if the cycle finally bites back. Until next time.